My name is Jim Weisel, Professor of Accountancy at Georgia Gwinnett College. In this video, I'm going to introduce the organizational structure of the shareholders' equity section of the balance sheet. So, shareholders' equity represents essentially the net assets of a company. The net assets are assets equals liabilities. We can go all the way back to the essential accounting equation, assets equals liabilities plus shareholders' equity. That's the normal organizational structure or presentation of a balance sheet in the United States, although that is not necessarily the case around the world. In any case, shareholders' equity represents a residual interest in the company, the owner's residual interest in the company. Shareholders' equity does not entitle owners to any specific assets, but rather it is what's left over of assets after liabilities are accounted for. The other thing that I want to raise here in chapter 18 and 19 is that we are talking about traditional C corporations. There are a wide variety of types of corporate forms of organization. In fact, the variety is growing. But a traditional C corporation began in the late 1800s, early 1900s, and there are an ever-increasing variety of corporate types of entities in today's economy. So, for example, there are limited liability corporations, LLCs. There are subchapter S corporations. There are master limited partnerships, or MLPs. There are real estate investment trusts, and there are BDCs, business development corporations. There's a wide variety of types of organizations, and each one of these organizations have different owner's equity accounting. What we are talking about here in this chapter is a traditional C corporation, the company that issues capital stock to a wide variety of potential investors, and that's what's covered in this particular chapter. Okay, so the organizational structure to shareholders' equity is actually pretty straightforward. Shareholders' equity is a group of accounts, just like assets and liabilities are groups of accounts. So we have a variety of different kinds of assets, cash and inventory and property, plant, and equipment, and intangible assets, and so on. And similarly, we have a variety of kinds of liabilities, a lot of which we've been talking about this semester in class. So we have accounts payable, taxes payable, net pension liability perhaps, capital leases, and so on. And then shareholders' equity is, again, a group of accounts. Most shareholder equity sections of balance sheets are going to share some common organizational elements, and paid-in capital is the first group of accounts within shareholders' equity. And paid-in capital represents the amount of funds invested in the company by its owners. Now, this paid-in capital is initially created when there is a public offering of stock. All of the subsequent trading of stock, the secondary market as it's called, which is a vast majority of what happens on, for example, the New York Stock Exchange or the NASDAQ exchange, when individual or institutional investors are buying and selling stock, they are very rarely interacting directly with the company. So if I own General Motors stock, or if I own some Delta Airlines stock, I can sell that on the market and it's being purchased by another investor. That actually has absolutely nothing to do with Delta. But the paid-in capital represents the initial investment made by owners of the company. And for traditional C corporations, there are a variety of potential kinds of or classes of stock. The two most typical classes of stock are common stock and preferred stock. In fact, for a company with only one class of stock, it must be common stock. These other classes of stock can come in subsequently from amendments to the corporate charter and so on. But if a company only has one class of stock, it must be common stock. And then they can do some of these other representations of ownership interest. In any case, paid-in capital will consist of the common and preferred stock, or whatever other classes of common stock, whatever other classes of stock there might be, as well as something called additional paid-in capital. We'll get to what those details are a little bit later on. But for now, we just need to know that paid-in capital represents the initial ownership investment in the company. Typically, the next section in the balance sheet is going to be retained earnings. Retained earnings is the accumulation of earnings that have not been distributed over time. So we know, for example, the income statement, basic structure of the income statement is revenues minus expenses, gives us net income, and then that net income is rolled over or rolled into retained earnings. To the extent that retained earnings or earnings are not distributed by way of dividends and so on, then that is going to be accumulated over time on the balance sheet. So the benefits of generating positive income over time and retaining that income in the company fall to or are ascribed to the shareholders or stockholders of the company. Now, as we have seen in class, for example, Delta Airlines has negative retained earnings at the moment. Negative retained earnings is typically going to be relabeled as accumulated losses rather than calling it negative retained earnings. In any case, that would typically be the second section or second element of a shareholder's equity portion of the balance sheet. Next, and there is a little bit of discretion here in terms of what happens after paid-in capital and retained earnings, and it's very much a function of the capital structure of the company. So every company is going to have paid-in capital, every company is going to have retained earnings or accumulated losses, and then the next three items that can appear as a part of shareholders' equity may or may not be there. Again, it just depends on the nature of the company. So for example, treasury stock. Treasury stock is always going to be a negative to shareholders' equity. Treasury stock will always have a debit balance if it exists. It will be a debit balance and therefore will be a subtraction from shareholders' equity. And what treasury stock represents is the repurchase of a company's own shares of stock. So for example, if Delta Airlines goes into the market and buys Delta Airlines stock, takes it out of circulation, that's going to be treasury stock. This is not Delta Airlines going and buying 3M stock. That would be an investment in an asset. This is when a company goes out and repurchases its own shares of stock. That's going to be called treasury stock. And then we've seen a variety of examples of accumulated other comprehensive income. The ones that we've seen most recently relate specifically to pension plans. We can have accumulated other comprehensive income or losses, AOCI accounts, as it relates to pension accounts. And then there are other comprehensive income items, gains and losses that a company can experience that the FASB has decided are not necessary to recognize on the current year's income statement, but nevertheless have an impact on shareholders' equity. And a lot of those relate to, for example, certain foreign currency exchange gains and losses and those kinds of things. Then the last item that can appear is non-controlling interests. Non-controlling interests represents the interest of in subsidiaries held by other companies or other individuals. So what happens is when a company purchases a subsidiary or buys a subsidiary, typically we will have a 100% ownership interest in that subsidiary. We just own all of the stock, and then that company, that subsidiary's assets and liabilities all get rolled into ours, all get consolidated with the parent company. However, in situations where we have a controlling interest, we own more than 50% of the stock, and therefore it is being consolidated, but we don't own 100% of the stock. Somebody else or some other groups of people own a non-controlling interest in that subsidiary. That's what's going to show up in shareholders' equity. And that's basically to balance the net assets, liabilities, and our shareholders' equity in that subsidiary. So paid in capital, retained earnings, then we subtract treasury stock. We will either add or subtract accumulated comprehensive income, these AOCI items, and then non-controlling interest. Non-controlling interest will always be a credit balance and therefore in addition to shareholders' equity. All right, so that's the basic organizational structure to shareholders' equity.